So I wanted to make an everything you need to know about option video. I actually recorded it, did 3 hours, but I accidentally deleted the first hour. I only have the last 2 hours. So I decided to do the first hour in chunks, in bits, because anyways, I think if I upload a 3-hour video, no one would watch the whole thing. All right, so the first thing I want to talk about is what are options? Just in theory, what are options? But for the rest of the videos, I'll talk about what is a call option, what is a put option, how can you trade options, do you need to own shares to trade options, how do you buy a call option, how do you buy a put option, when do you buy them, why do you buy them, buying options versus selling options, what is assignment, what is exercise, can you get early assigned or exercised, and then all the different strategies related to options. By combining calls and puts, you can come up with all these different strategies. All right, so first, what are options? So options, like it or not, options are insurance. They are insurance on the stock. So you got two types of options. You've got a call and you've got a put. A put is an insurance against your stock falling. So you'd buy insurance to protect your stock from falling. And a call, you'd buy a call to protect the stock from going up. So you might say, why would I want protection against the stock going up? There are scenarios where you would want protection against the stock going up. For example, instead of owning shares, you actually shorted shares. So for example, I'm looking right now at the SPY. The SPY is an ETF that tracks the S&P 500, which tracks the top 500 stocks, American stocks. Let's say someone shorted shares of the SPY at a 330 strike, but then was worried that the stock would go up. When you short shares, you basically have to buy it back. So you open the trade by selling your shares. You open the trade by selling shares that you don't own, but then to close the trade, you have to buy it back. So the loss is unlimited, potentially, because the stock can go to infinity. So if you want protection against that, someone would buy a call option for that protection. So in theory, calls and puts are insurances against the stock depending on the scenario. Puts, you want to buy puts if you want to insure your stock from going down, and you'd buy calls if you want to insure your stock from going up or your position from going up. Now, obviously, that's not how most people use it. Most people just trade the options. They buy it and sell it, buy it and sell it. And as you can see in this option chain, there's a column called strike. So basically, the strike is the protection that you want. So if we take the analogy of car insurance, when you buy car insurance, you're paying insurance, you're paying premiums to protect against a car accident or car theft or loss or damage or whatever. And depending on how much protection you want, you'll have to pay more in premiums. So that's the exact same thing in terms of the strike. Let's say I bought 100 shares of SPY at 323 and I want to protect it at 323, meaning that if the stock goes below 323, I'm protected. I won't lose anything more than 323. So if I buy a put option, which is the protection against the stock going down, I'm gonna have to pay $1.05 premium. That'll be the premium that I'm paying, the insurance premium that I'm paying to protect my shares against 323. But let's say I'm okay losing a little bit, but I don't want to lose more than 320. If the stock goes below 320, I'm protected. So so I'm getting less protection, I'm getting less coverage. So that's why the insurance premium that I'm gonna pay is gonna be less. So it's the same concept. Same thing on the call side. So this is the put side and this is the call side. So same thing, except that you're protecting to the upside. You're protecting to the upside in case the stock goes up. And like I mentioned, what is a situation that you would want protection against the stock going up? It's if you actually shorted shares. So because it's insurance, it has a contract, it has a term, it has a period, it has an expiry. Usually you're insured for a year with your car insurance and then it gets renewed. Well, with options on stocks, you have several expiries. The most popular is weekly. Most stocks have weekly expirations. The SPY, an exception, has 3 days a week expiries. So you can see September 21st, September 23rd, September 25th. So for example, let's say I own shares, 100 shares of SPY at 323, and I want to protect it at 320. I don't want to lose more than $3, 320, the current market price, and my protection of 320. If I don't want to lose more than that, I'll pay 29 cents, but I'm only protected until September 21st, which is today. If I want to be protected until, let's say I want to be protected until October, or let's say I want to be protected until January 2021, that insurance is going to cost me more because I'm covering a larger period. I'll have to pay $19 per share, so that's $1,900. So one option contract represents 100 shares. So that means I'd have to pay $1,900 to protect my 100 shares of the SPY in case it drops below 320 between now and January 15. Now, obviously, if the SPY drops, the value of this insurance will go up. So if I keep making car accidents and I keep making claims, my insurance is going to go up, my premiums is going to go up. So same thing, if the stock drops, the premiums go up. If the stock goes up, the call option premiums go up. But if the stock drops, then the put option premiums go up. So that's how most people trade options actually, is that if they think that the stock is going to go up, they'll buy a call option without even owning shares. So you don't even have to own shares to trade options. You can basically make directional bets. If you think a stock will go up, you can just buy a call option based on the period that you want to be exposed to. If you think a stock will go down, you could buy put options against it. You can buy put options without even owning shares, but you're basically trading options and you're making a directional assumption. So for example, let's look at a September 25th expiry, which is this Friday. So let's say SPY right now is trading at 323. Let's say I think that it will go to 330 by this Friday. So I could buy a call option and I have the choice of all these strikes and more. So let's say I buy the 325 strike, I'm gonna have to pay $3.50. Now, if SPY starts moving up, this $3.50 is gonna go up in value. But the problem is there's an expiry, which is September 25th. And the value of this option at 325 by September 25th will be worth 0 if SPY is trading below 325. So I really need to be right with my direction. If I think SPY is reaching 330 by this Friday, then that needs to happen, or else I'm going to lose money, because that call option that I'm buying at 350, as you can see, it's already dropping in value. Now it's back up, will be worth 0 if SPY is below 325. But let's say SPY is at 326, then this call option is going to be worth $1. So I would still be losing money because I paid 350. If SPY is trading at 327, this call option on expiry, September 25th, will be worth $2. So I'm still losing money. So basically my break even for me to not lose any money is 325 plus what I paid in premium. So if I buy a call option because I think the stock's going to go up, my break even at expiry is basically the strike price plus the premium that I paid. That's my break even. Anything above my break even will be profit. So if SPY is at 330 at expiry, my profit will be 330 minus my break even. So 330 minus 325 minus the premium that I paid. So about $1.50. So my profit will be $1.50 on a $3.50 investment. So the return on capital is pretty high because it's $1.50 over $3.50. But it comes with a risk, because if I get the direction wrong, I basically lose everything I paid. That's the risk. So if I buy one call option, I'm going to pay $350. And if SPY is at 330 by Friday, then I'm going to sell it for $500. And I'm going to make a $150 profit. So it's always in increments of one contract. So one contract, two contracts, three contracts, which represents 100 shares. So it's if I buy two contracts, that's going to be $700 that I have to pay. 200 shares times 3.5. See, now it's already at 3.6 because SPY is going up. SPY was trading at 323 when I was talking. Now it's at 324. So that's why the value of this call option went up. So in fact, some day traders of options or scalpers will actually buy a lot of contracts at 350, for example, and sell it at 360. So they just made a decent return depending on the capital that they were trading with. But once again, you need to be on par with your direction. So the definition of a call option, if you buy a call option, it gives the buyer the right, but not the obligation, to buy 100 shares of that stock at that strike price chosen. So if someone buys the 325 call option, pays $3.60, the buyer has the right, but not the obligation, to end up owning 100 shares of the stock at 325. So if SPY flies to 340, for example, by Friday, the buyer of the option has the right to exercise his option, which will mean that he will end up owning 100 shares of the SPY at 325. But the SPY is trading at 340, so he'll make a profit of the difference, 340 minus 325. But he paid premiums for that, so you have to consider that. So it's actually 340 minus 325 minus the premium that he paid. But most of the time, instead of exercising, he could just sell that call option and he'll make the same profit, if not more. So SPY's at 340 before expiry, his call option will be worth much more. It'll be worth at least $15. Why $15? Because 340 minus 325 is 15. At expiry, that'll be the value of that call option. So why go through extra steps of getting exercise, owning the shares, and then selling back your shares at 340 when you could just sell the call option you bought? Plus, it requires less capital. If you buy 100 shares of SPY at 325, that's $32,000 that you have to put up. But if you buy one contract one call option at a 325 strike, it's only going to cost you $365, which you can then sell for $1,500. Let's say SPY is at 340, which is unlikely. I'm just giving you an example here. So same idea on the put side, but the inverse. So you'd buy a put if you think the stock would go up. So if you don't own shares, if you're not buying puts for protection, if you're not buying puts to insure your shares, you want to trade options, you want to trade puts, you would buy a put if you think a stock will go down. So for example, SPY is at 324 right now. Let's say I think it's going to be at 320 by September 25th expiry. So what I could do is, at the same strike again of 325, I could buy a put option that'll cost me 4.3. So if SPY is at 320 by expiry, this put option is going to be worth $5. 325 minus 320, so it's going to be worth $5. But I paid $4.27 for it. So my profit is the difference. $5 minus $4.27. That's my profit. And that happens if SPY does end up going to 320 by expiry. If it doesn't, then if it stays above 320, then I lose money. What's my break even? My break even in this case on the put side is 325 minus the premium that I paid. Remember, on the call side, my break even was the strike plus the premium paid. But on the put side, because it protects against the downside, my break even is my strike minus the premium that I paid. So my break even is basically 320.75. So I need SPY to trade below 320.75 by Friday if I buy this put option, because that's the assumption that I'm making. But based on the strike that I choose, my break even is different. So I have the same assumption. I assume that the stock is going to drop by September 25th. But instead of choosing the 325 strike, which will cost me $4.25, I could choose a 330 strike. So based on the different strikes, my break even will be different. So if I buy the 330 strike put option, I'll pay $7. So what's my break even? My break even is 330 minus 7. So my break even is 323. So I have a lower break even, or a closer break even. I could start making money sooner. But guess what? I'm going to pay more upfront. But that means I just need the SPY to trade below 323 and I start making money. But in the case of buying the 325 strike, I need the SPY to trade below 320.25 to start making money. I need the SPY to trade below 320.75 to start making money. At all the choices and flexibility you have based on your assumption, based how much money you want to make, how much profit potential you want, or how much margin of error you want. I can go to the 340 strike and my break even will be much better. 340 minus 16, that's my break even. So that's 324. So I start making money if SPY drops below 324. But if I buy the 340 put option, I'm going to have to pay $1,600. So if I'm wrong on my direction, I could potentially lose $1,600. Now, if I go back to the 325 strike and I pay, right now it's trading for $4.45. Now I don't have to wait till expiry to sell my option. If the SPY drops right now or tomorrow hard, this put option will be worth more. As you can see, it's already changing in value. So I could sell it before expiry and make a profit if the stock starts moving in the direction that I'm predicting. But it's important to know the value of your option at expiry, because as you get closer to expiry, these premiums lose value. So if you have car insurance, for example, as you get closer to your expiry, you're less protected. If you call your insurance company, say I want protection for just a few weeks versus you ask for protection for 12 months, you're going to be paying less, of course, for a few weeks. So that's what's happening. These premiums are dropping in value as you get closer to expiry if the stock is not moving in the direction in your favor. So the definition of a put option, if you buy a put option, it gives you the right to sell 100 shares at the strike price of your choice. Now it gives you the right, but not the obligation. So if you buy a put option, you don't have to exercise it. And you would only exercise it if you actually own 100 shares. But in definition, that's what it is. So if someone bought SPY at 325, they want to protect it at 320, so they'll buy a put option at 320, and it gives them the right to sell their shares at 320. So if they bought SPY at 324 right now, and they bought the put option at 320 strike, worst case scenario, between now and September 25th, the lowest they can sell their shares at is 320. If SPY drops to 300, they can still sell their shares at 320. So that's what they're buying here. That's the protection. That's the definition of a put option. But like I said, the way that it's mostly used is by just trading the option without owning the shares, simply by picking a direction. All right, so in the next video, I'm going to talk about what is out of the money, what is in the money, what is at the money, what happens if an option expires in the money or out of the money. All right, so if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. Also, check out the other referral links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.